The Intelligent Investor by Benjamin Graham is a seminal work in the field of value investing, providing timeless principles for managing investments. First published in 1949, the book emphasizes a disciplined, long-term approach to investing, advocating for careful analysis, a margin of safety, and protection against substantial losses. Now let's dive into the key concepts presented in the book. Investing versus speculating. Investing involves a careful analysis of a company's fundamentals, aiming for a safe and adequate return, while speculating is similar to gambling, where decisions are based on short-term market fluctuations or emotions rather than intrinsic value. The concept of Mr. Market. Graham introduces the metaphor of Mr. Market, a fictional character who offers to buy or sell shares every day based on his emotional state. Sometimes Mr. Market is overly optimistic, and other times he is irrationally pessimistic. The intelligent investor should take advantage of Mr. Market's mood swings, buying when he offers undervalued shares and selling when they are overpriced. Margin of safety. One of the core principles of Graham's philosophy is the margin of safety. This means investing with a cushion against errors in judgment or unforeseen market declines. It involves buying stocks or bonds below their intrinsic value, ensuring that even if the analysis is imperfect, the investor is still protected from significant losses. Defensive versus enterprising investors. Graham categorizes investors into two types. Defensive investors, those who prefer a more passive approach to investing, focusing on preserving capital and avoiding substantial losses. He recommends a diversified portfolio of high-quality stocks and bonds. Enterprising investors, those who are willing to put in more time and effort to research undervalued stocks. They actively seek out market inefficiencies, small-cap stocks, and special situations like turnarounds or corporate events. Diversification. Graham emphasizes the importance of diversification to reduce risk. He suggests that investors hold a portfolio of diversified stocks and bonds to minimize the impact of any single investment's poor performance. Value investing. The book is often seen as the Bible of value investing, which focuses on finding undervalued companies with solid fundamentals. Graham advises against chasing high-growth stocks with high valuations, which are more vulnerable to market volatility. Market fluctuations and the psychology of investing. Graham warns against emotional decision-making, urging investors to remain rational and objective. He suggests that the market is often driven by human emotions, greed, and fear, which can lead to irrational pricing. The intelligent investor should remain detached and base decisions on fundamental analysis rather than market sentiment. Bonds and fixed income investments. In addition to stocks, Graham discusses the role of bonds and other fixed income investments in an investor's portfolio. He believes they are an essential part of a balanced approach, providing stability and income, particularly for more conservative investors. Earnings and dividend policy. Graham places a significant emphasis on a company's earnings and dividend policy. He suggests that investors look for companies with a consistent and stable record of earnings and dividends over many years, which can be a sign of a well-managed and financially sound company. The intelligent investor's mindset. Graham concludes by stating that the intelligent investor's success depends more on character and temperament than on intellect. The keys to success are patience, discipline, and a firm commitment to the value investing philosophy. Key takeaways. Focus on value. Buy securities when they are undervalued. Stay rational. Avoid emotional reactions to market fluctuations. Preserve capital. Always invest with a margin of safety. Diversify. Reduce risk by spreading investments across different asset classes. Think long-term. Maintain a disciplined, patient approach to investing.